Adobe is reporting earnings the 10th of December. The stock is down 37% in the past year. In this video, I am going to do an in-depth analysis of the company by analyzing both the qualitative and quantitative aspects of the business. Let's start with the quantitative, which includes going through their fundamentals and running a discounted cash flow model to see what returns we can expect if we buy Adobe stock today. Even though Adobe stock price has decreased, its fundamentals haven't stopped growing. Their revenue has grown in the past 10 years from $4.7 billion to $23 billion currently, and analysts are still projecting very good revenue growth in the next years, as they have Adobe reaching $24 billion this year and grow to $36 billion in the next 5 years, which is a compounded annual growth rate of around 9%. Their profit has also seen massive growth in the past decade, growing from $600 million to almost $7 billion today. And they have even more free cash flow, currently at $9.5 billion. Analysts are also expecting profit growth. Regarding earnings per share, they have Adobe reaching $21.25 per share this year and grow to $34.14 by 2030. I agree with analysts' view because Adobe has fantastic margins, with gross margin nearly at 90%, profit margin around 30%, and free cash flow margin at around 40%. Another thing that is going to drive EPS growth is share buybacks. As the stock has gotten cheaper, management has decided to buy back shares. This is very good for investors because you share the profits of the company with less people and you own a larger portion of the company basically by doing nothing. And regarding the valuation, Adobe is now trading at a price to free cash flow of 15, its cheapest valuation in a decade. But in order to take a deeper look at the valuation, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $224 per share, middle $441, and high $591. And because the stock is currently trading at around $346 per share, this means that if my low assumptions occur, you would get an 8.8% annual return on your money, middle 14.6%, and high 20.1%, which are great returns because keep in mind that the market gives you around 10% per year. So according to my middle assumptions, you would beat the market by almost 5% annually. Now, as far as my assumptions, I assume Adobe grows revenue between 6 and 10% annually for the next 7 years. The average of profit margin and free cash flow margin between 33 and 41%, and I assign the PM price to free cash flow at the end of the 7 years of 16, 18, and 20. And I even left the share outstanding change at 0% in order to be more conservative. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Now, the spreadsheet does not take into account the balance sheet, but Adobe has an amazing balance sheet with $5.9 billion in cash and $6.6 billion in debt, which is nothing for a company that has a market cap of $144 billion. And as we have seen, Adobe's fundamentals are perfect. So why is the stock down this much? The main fear is that AI will replace Adobe. If AI is good enough for generating videos and photos, why would you manually need Adobe? And sure, the technology is not there yet today, but what about 5 or 10 years in the future? So will AI completely replace Adobe? And another fear that people have is increased competition from cheaper alternatives such as Canva and Figma that are taking market share. But in order to see if this is a real risk, let's take a look at what exactly is Adobe, because this is very different from every person's point of view. Some people know it as the PDF company, others know it as the Photoshop company, and some of you as the industry standard for editing videos. A lot of YouTubers, for example, use Premiere Pro to edit their videos. They have around 60 different apps, and the bundle they typically sell is the Creative Cloud, which costs around $70 to $100 per month. But you can just buy the apps individually. So who is the customer of Adobe? According to their data, 70% of their customers are professionals, and 90% of their revenue comes from professionals. And what I mean by professionals is people who are working in a company. For example, the workers of Coca-Cola, Nike, or even a small marketing firm. It is a software for professionals. And this is very important in order to answer the question, will AI take over Adobe? Because for a low-end user or customer, this might be the case. If AI gets good enough, you might be able to use cheaper alternatives. For example, if you're a YouTuber that only uses Adobe for thumbnails. But if you're Nike and are spending millions of dollars in ads, you need control and perfection, which is something that generative AI will never offer. And Adobe, in a sense, will benefit with AI, which they are already making through AI integrated features. And in summary, I believe Adobe will not be disrupted by AI. The fundamentals are just getting better and better, and this is a good opportunity to buy a quality company at a discount. I decided to start a small position and dollar cost average on the way down if the stock continues to fall. Lastly, if you want a discount at stockanalysis.com, the best place for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Adobe stock in the comments, and I'll see you in the next one.